Hey everyone, how's it going? Good to see you guys. It's good to be back. I am a little tired from all my travels, but today's been good. It's been really good. So let's go ahead and take a look at what the market has in store for us. I need to find where all my charts are. That's really weird. Not that. And why can't I find anything? Is this it? Okay, here we go. I think that, no, that's not it. Hmm, this? No, I lost all my charts. That's interesting. This one? All right, I guess I'm just gonna have to open all my windows. Okay, let's I lost you guys. Where are you guys now? All right, sorry guys. The coming back, it's like from travel blues. Hey Spider Monkey. Hey Kevin, great to see you. Missed today's trade. Oh no. Was it just moved too fast on you or came too late? What happened over there? Hey Tim, good to see you. Let's take a look. Okay, there we go. All right, so last week, well, the one time I talked to you guys, and the week before that, I was talking about how there's not a lot of catalysts in the market, that we're most likely going to chop sideways, and that's pretty much what we did. So over here, we chopped sideways. Yeah, we had that dip below that EMA 8 or 20. And then I said it was unlikely to make new highs, or if we did, it wouldn't be that much higher. And that's exactly what happened. Yesterday, we gapped open to an all-time high, but we traded right back down. Right now, we're in the middle of it. We were just kind of holding at this 649-ish area, and there is a lot of gamma exposure around 650. That's going to make it hard, at least for a while, for us to move significantly higher. Now, if we do look at gamma, there is exposure going higher. I will show you that in a little bit. But for now, without any real catalysts, and it being September, and we're just coming back from a holiday last week, that this is the real first full week of trading, there's still not a lot of stuff that's going to move this market. We have some major economic reports, CPI, PPI. Normally, that would be really important to us, but the market has pretty much baked in anything that the Fed is going to do. So if I do the Fed watch, what we'll see is that, oh wow, now there's, okay. So basically we're 100% priced in that there is going to be a rate cut on September. And now, for whatever reason, the market is now thinking that there's even an 11.6% chance of there being a 50 basis point rate cut. So basically, if the Fed does not cut on September 17th, then the market is going to fall hard and fast. If we get the cut, then fine, no problems. We'll probably just status quo. We'll probably go up a little bit and start floating upwards. And then if they actually cut by 50 basis points, then the market will go screaming higher. Now, I don't know why they're baking in 11.6% on a 50 basis point rate cut. It's completely unjustified. If this happens, that would be a completely political move, and Powell has not shown any sort of desire to bow to political pressure. So I don't really see this happening. It would be completely unjustified. The only thing that is telling them that it's okay to cut right now, or makes them kind of more urgent to cut right now, is the fact that jobless claims are not doing so well. So if you recall the previous jobless claims report, it got revised, and it got revised by huge numbers and a lot worse than what they were originally reported. And the difference was so big that Trump used it as an excuse to fire the head of the BLS. Well, it happened again, where the previous jobless claims last week, we got a revision, and it got revised quite a bit lower, not nearly as much as as the previous one, but this one got revised lower as well, and it's just not looking that good anymore. So that is giving cause for the Fed to want to cut rates. And then we've got jobless claims coming up again on Thursday. And again, yeah, we have consensus at this at 234. We have this range at 225, 247. That's what we've been seeing for years and years and years now. The problem is the revisions. If we keep revising, it's like, oops, we said it was 250,000. Oops, it was negative 40,000, right? That is not going to be something that is going to look good for the economy, not going to look good for Bureau of Labor and Statistics, and it's just not going to sit well for investors. We don't know what to trust anymore. The other thing that is really interesting is that the yield curve, US yield curve, I hate it when they give the table. Show me the chart. Man, yeah, the Department of Treasury always gives this chart. I forgot how to get it in the curve without having to plot it myself. I don't know why they do that. They should just show you the curve. Let's just go to usyieldcurve.com. And what we're seeing right here is that we're re-inverted by about, what is this, for down here at the low, about 25 to 50 basis points, okay? So just call this 420 just to make it a little easier. And this is about 470, okay? So that's roughly 50 basis points. That's a re-inversion of the yield curve. And that is a fairly reliable signal of pending recession. It's not a guarantee, but it makes it a lot likelier that a recession is going to happen. So you guys might have heard of the inversion of the yield curve, and that's the recessionary sign, but that's a recessionary sign within 2 years, which is not great predictability. But the reversion, so that means when, let me see if I can get G-Ink on here. Let me draw G-Ink, no. Okay, I guess it doesn't want to let me do G-Ink. Boy, you go away for a week and nothing wants to work anymore. Okay, where can I draw this? Paint? Okay, so normally we expect the yield curve to look kind of like this. It's not perfectly straight, but conceptually we can think of it like this. Over here in the short term, we should expect to pay very low interest rates, and in the longer term, we should pay higher interest rates. So if I want to borrow money for 1 month, it shouldn't cost me as much as if I wanted to borrow money for 30 years, right? That it makes intuitive sense. But when things get distressed, sometimes that happens. And why does that happen? Is because the banks think that in the short term, there's a lot of risk. And they don't know if you're going to pay your money back. And they don't know why you're taking a short-term loan. I was like, oh, well, if you can't qualify for long-term, maybe that's why you're going for a short-term. So when this happens, that's the inversion of the yield curve. And a lot of people talk about how this is a sign of upcoming recession. The problem is it's sometime in the next 2 years. It's just not that good of a timing vehicle. It's when we revert, when we were like this, then we went like this, and then we come back like this. That is when a recession is more likely to be imminent. And that's what we have right now. So finally, there's enough distance between the short end and the long end, about 50 basis points, for us to start considering that that is a reversion of the yield curve. Before it was flatter. So yeah, this was higher than that, but it wasn't 50 basis points higher. So now we're starting to have some recessionary risks come into play. We're seeing the jobless claims go down a little bit. And if the Fed starts responding to the jobless claims more than it's responding to the inflation and it's going to start cutting, then two things can happen. The very best case scenario is that you have a soft landing, but that's really, really hard. And in history, it's so hard that in history, the US has never had a soft landing successfully. Okay, so that's about as much confidence as we can have in a soft landing. The next thing that can happen is stagflation, which is basically the economy isn't really growing, but the CPI keeps on going up, which is terrible. Those are a very, very bad case scenario. And then the other thing that can happen is, we can sort of skate our way through this, and basically this comes back down. So basically we have that re-inversion where this rate goes above this rate. And then what that means is we're kicking the can down the road. Okay, we won't have a recession now, but when it finally reverts again, where the higher interest rates are on the long end, then that second re-inversion is where we start to see that recession. So I don't know which one is going to be yet. Either this is going to come down in response, and then we're saying, okay, not yet, we're going to kick the can down the road, or this is going to keep on getting stronger, in which case then we have to worry about a little bit about recession or stagflation. So let's take a quick look at what bonds did today. And we might get a small clue. Oops, what are TLT? Okay, and see what happened is the Treasury over the last couple of days, the U.S. Treasuries, the long end of the U.S. Treasuries have been jumping up. We passed this MA200, which has been a challenge for a very long time, since the beginning of this year or sometime last year, where we broke below the MA200 and just kept on trading below it. Now we finally pretty much definitively broke above the MA200. We did on this day right here, but there was a lot of negative momentum there and just fell right through. Here, we closed above on Friday. We gapped up even higher today and ran upwards. So we have we have for sure one full day where the entire bar is above the MA200. All we need is one more, and that's it. So this is a likely change of trend. So you can't quite call it yet, but you see that? On Friday, it basically hit that trend line right there. How do I get this trend line? Connecting this high to this high. And it happens to move through exactly at the MA200, and where we closed Friday, we closed barely above it, but we could say maybe it will reject. But today, it gapped higher and then ran upwards. So if bond prices go up, when this is the long bond, 20 years, okay? If bond prices go up, then that means yields go down, okay? So if yields are going down, then, oops, did I lose it? Then this is moving downwards. And if it moves downwards, we might get a re-inversion of the yield curve, and then we're kicking the can down the road, okay? And the recession gets delayed, but when it hits, it's probably going to be harder than it would have if we just allowed the recession right now. Okay? So that's where we are right now. It looks like maybe we might get that re-inversion, at least based on so far what we're seeing in the pattern in the TLT, what TLT is giving us. Okay, so I'm not expecting recession anytime soon, not in 2025, 2026, who knows? It just depends on that yield curve, exactly what we were just talking about right there. So why did we get on this topic? There's not a lot. There's not a lot that can influence this right now. So these catalysts that we're seeing right here, I don't know that they're going to have a very large effect on the markets. And right now, as we were talking about the one time we talked last week and pretty much all of the previous week, is that this is chop. Even though we went to the EMA 20, I was talking about how even if we went to MA 50, that would still be sideways chop. And we've got this box right here. Okay. That we've been trading in. Okay, but I could even extend this lower to maybe here. Okay, that would all be sideways chop to me. that would be normal. Maybe not this low, but this would be normal. The MA50 right there, that would be normal as well. So a narrow range chop would be right over here. And I don't see anything that can get this market really excited and move upwards. Now, in a moment, when we start looking at sectors, maybe I'm wrong. Okay, so what could change? What could convince me that I'm wrong and that this could move higher? If I see a lot of strength in small caps, if I see a lot of strength in tech, XLK tech, like big cap tech, if I see a lot of strength in mags, if I see a lot of strength in SMH, right? So I really need those growth sectors to really show a lot of strength and not just the mags. So mags have been holding up this market for a very long time now. And without participation from the rest of tech, then it's going to be very limited. Retail also, I want to see a lot of strength in retail. So we can take a look at that. Let me see what you guys are saying first. Audio is low. All right, let me check on that. Huh. How's that? Is that better? Yeah. A lot of things changed while I was away. That's kind of crazy. Hopefully that's better. Yeah, the market moved fairly quickly in the last few minutes of the day. So if we look at SPY, I don't have any of my charts open. That was not what I was looking for, but okay, good enough. Yeah, see right there on that last surge upwards, it actually broke the VWAP in the last few minutes. Right there, that last bar went a little bit higher. So yeah, that surged quite a bit in the last 30 minutes, but especially the last 10 or 15 minutes right there. Why a lot of people talking about the morning payout plan. So again, this is public forum, so I won't talk specifically about the morning payout plan. Why diagonal? Why would you choose a diagonal versus a calendar? I can talk to that because that's a more general question. So if I look at a option strat, what is the difference between a diagonal and a calendar? The only difference is that on a calendar, you have the exact same spread, or sorry, exact same strikes. So when you do that, usually there's not this weird skew right here. Okay, usually it'll be flat. There is skew in the market right now, or maybe I should do SPY. Maybe there's less skew. Yeah, there's still there. Not as much, but still there. Almost the same, actually. That was, yeah, almost the same. So there is a little bit of skew right here. Normally, we would expect it to be, if there was no skew, these would be perfectly level. It would just look like a perfect triangle, except with these little curvy lines right here instead of flat sides. So, or I should say straight sides. So here, basically, you have a 50-50 chance from left to right. So if the market was currently or closed perfectly at 649 and we centered our calendar at 649, then you'd have a 50-50 chance of it going lower or going higher. And the return that you get on each side would be the same. So the drop off would be the same. So if I moved $1 to 648, versus $1 to 650, that return would be the same. And you can see here it's pretty close. Right here at 650, we're expecting about 36% return if we held this to the end of day tomorrow. And if we did this, okay, then 34%. So they're basically the exact same. Now, if I do a diagonal, okay, you see what happened to that curve? All I did was just move it one single strike. What it did was it made a lot less risk to the upside. So if we're wrong and this thing gaps way up tomorrow morning and we hold to expiration, well, not too bad. The worst we can do is 18% loss of the invested capital. Not bad. That's not bad. So it's a lot more forgiving to the upside. And I have a better chance of making some profit over here. So if we went from 649 to 650, right here, we're expecting about a 28% gain if we held to expiration or on the short leg, which is tomorrow, 9th, versus if I move down $1 to 648, okay, what do I expect right here? We'd only make about 9.6%, about 10%, okay? So basically we took some of that gain that was on the left side of the curve and we shoved it to the right side of the curve. We made it a lot less risky on the right side and then a little bit more risky on the left side. That's the major difference. And the more I move this, the more it happens. So if we did this, then there's zero risk to the upside. No matter what, no matter how far up the market goes, then there's no possibility of a loss. We'll at least make something, at least 3.1%. Not bad. But then again, it comes at the cost of a lot less wiggle room to the downside, and then we can lose all the way to 100% over here. Okay, and then the more I do this, the more it starts to look like that. Okay, so basically it starts to look a lot more like a vertical. Okay, so if I did debit spread, for example, debit call spread, and I did a 5 wide debit call spread, it starts to look a little bit more like that. Okay, so call spread would be straight line, vertical, straight line across, instead of this baby dip and then across. So the reason why you would choose a diagonal instead of a calendar is if you did not think that the risks of moving down was the same as moving up. Right? If there's a higher probability of it moving higher than lower, then you would start skewing it like this. Okay? That's why. Okay? Hopefully that was helpful and answered your question. Hi Kay, good to see you. Psychic Crystals, Mark, Kevin, John, good to see you. Venkat, lumber prices are falling hard, canary in the coal mine for a recession. Yeah, housing starts are low. Interestingly, HB has been doing really well, still doing really well. So, I don't know. So inputs into home builders, it looks like are starting to slow down. But home builders themselves, maybe they're thinking that the lower interest rates will still keep people buying, and maybe there's pent up demand. So we'll see. I'm not super. I'm a little surprised by this run in home builders, but those guys they know their stuff, right? They know their risks really, really well, and home builders are indicating that there's still room for them to run up. Of course, we could hit some resistance right here. Right up here, a little bit higher than where we are, and then a little bit higher than that. We could hit some resistance, but we'll see. So far, home builders are holding up. How do different dates affect? That's a good question. Okay, so if you're doing a calendar, then the different dates, basically they just widen everything. You see that? Everything just gets wider. Okay. But the other thing that happens is that your reward risk ratio gets worse. So the wider something is, the more probability you have of staying in profit, but the cost is the profit versus your risk becomes worse and worse. So this one, we started out with a $68 versus $69 max loss. This is a 1-to-1 reward risk ratio. And the further I go out, that reward risk ratio gets worse and worse. See, so if I only went one more day out, it's 72 versus 162. That's not even 50%. Okay, so it's slightly worse than a 1-to-2 reward risk ratio by just moving one day. So it went 1 to 1 to slightly worse than 1 to 2. And then I go one more out, then we're talking 80 versus 220. Okay, that's almost 1/3, right? So that it gets worse. It gets worse pretty fast. it gets worse really, really fast. And same thing's true on the diagonal. Okay, so the same effect on the diagonal. Okay, all right. So good questions, guys. Now, one thing that we can do to take advantage of potential chops sideways is that these because, so for example, if we look at what happened today, that's the time factor I've talked about. Yeah, you have to be aware of what time does to your probabilities and your spreads. So either you have to wait a long time in order to make your profit, or your reward risk ratio goes really bad. Hi, Geenum, or Genum. I don't know how to pronounce that, but maybe stupid question, but with everyone expecting rate cuts and one final push in Q4 with a big sell-off at the end, how big can the push-up stocks and crypto really be? Just depends on the euphoria in the market, the craze in the market, right? In those last stages, the euphoria and craze can be pretty fantastic. Because what could happen, I should say, is it just say we say, oh, we're not really expecting it to go that much higher. Maybe we might hit 700 by the end of the year, but maybe like 680. And we have 4 months left in the year. Well, what if we hit 680 in just 1 month? What are people going to think? Are they still going to think, oh, we're going to have a recession? There's probably going to be a lot of headlines saying, oh, we're at crazy all-time highs, this market, and then people get fear of missing out. And they go, oh, wow, well, we thought we were only, we might hit 680 by the end of the year. We already did it in just 1 month, and now there's 3 months to go. I missed out because I thought there was a recession. I put on a bunch of puts. I lost a bunch of money because of that run upwards. Let me flip my trade around and let me trade to the upside, and it runs and it runs and it runs. Okay, so it could go a lot higher because people get emotional and things get frenzied. So there's still potential room. Now 700, I think, is going to be difficult based on what I'm seeing right now in the markets. 680, I can believe, but let's look at some levels. Why do we need to guess right here? Let's see what the market thinks and not us. So let me see if I can get my upcoming Gamma software open. Hopefully it'll load. Because they're making some tweaks for me in the back end right now. So I don't know if they locked it down because they're making those changes. So let's see. We'll see if that loads. And then we can start looking at some interesting Gamma levels. And then we can take a look at how to take advantage of this. So the other thing that is happening that is really, really interesting is breakouts in gold. So if you recall, probably 2 or 3 weeks ago, maybe like a month ago, we were talking about gold, and people are like, oh, gold's breaking out, gold's breaking out. And I said, I don't see it. I always see a sideways chop. And that's all it did. It just kept on chopping sideways. And I even showed you guys an example trade on a gold, I think it was an iron condor, and that ended up making a lot of money. And then what I said over here about a week and a half ago to 2 weeks ago, I said, it's really interesting because gold isn't really moving, but the gold miners are screaming higher, right? They were just, let's go back to, when did I leave? I left on the 28th-ish, 27th. So if we go to gold and we go to the 27th or 26th, okay. So sometime during this time period, in just the last 4 bars over here, I said it's really interesting. We're chopping sideways on gold, but gold miners are really moving. So if we go back to GDX, okay, this is the correct period. So that was really moving. So that's a divergence, and divergences correct themselves. So it happened that gold went to follow GDX instead of the other way around. And we also noted that GDXJ was doing the same thing. So that's probably a signal that it was more likely that gold would follow GDX. And then what happened with gold is that finally over the weekend, basically, it broke out, right? So that Friday before the weekend, it kind of broke out, but this is not confirmation yet, because look at that right there. It'd be hard to say, to just be conclusive that this was a breakout. And then over the weekend, some news hit, and then Monday gap up and run, okay? So that happened probably a little too fast for most people to catch, because if you're waiting, unless you caught this on Friday and you were just so certain that it would be this level right here, then you would be waiting. I would have been waiting. I wouldn't have caught that. I would say, okay, Monday. But then Monday, the gap up and run, it's just too much too fast. So it didn't really provide any good entries. You see, even all the way till now, it hasn't provided any good entries. So this is for sure a breakout. But if you want to be optimal with the gains in your money, if you're a short-term trader, if you're a longer-term trader, doesn't matter. Right? It's just noise. But if you're a short-term trader, you want to optimize your entry. And it's much more important to optimize your entry than it is your exit, in my opinion, because if you have a bad entry, you're forcing yourself to have an excellent exit. But if you have an amazing entry, then you can have a crappy exit. Okay, you'll still make money. But so it's far more important, in my opinion, to have a really, really good entry. And it's a lot easier to figure out what a really good entry is than it is a really good exit. So it puts everything in your favor if you just focus on the entries a lot more than your exits. So a perfect entry gives you a lot of leeway with what you can do with your exit. But a crap entry means you got to be amazing on your exit. You're just forced to be really, really good on your exit. Okay, so that's why I wouldn't chase into this. I wait for really, really good, solid entry. Unless I'm a long-term trader, I'll just buy shares of GLD and hold on to it for a few years. Let's see. Oh yeah, you're welcome, guys. So Europe was on vacation the last 2 weeks of August. Really? I didn't hear it. I was in Europe, at least for the last few days of August. I didn't hear that they were, it didn't appear that they were on vacation. So what do we do with gold? Gold is really interesting because I drew this on the chart, ascending triangle. It broke out of that. But if we look at a longer scale, oh gosh, that's going to be, so let's go on a weekly scale, okay? On a weekly scale, we see the same thing. Well, that's the same ascending triangle as on the monthly or on the daily. Let's look at monthly. Okay, and it's the same thing. Okay, so basically what happened was there was a breakout right here. Okay, so if we do this, this was another ascending triangle right here. So ascending triangle breakout, now another ascending triangle breakout, except this is on a monthly. So this is on a much longer time scale than this one was. So the real breakout in gold, the real longer term breakout was right here. And if you look at this, it's actually a really long-term breakout starting from 2011, okay? That would be what some people call a cup and handle pattern. To me, it doesn't matter. I don't care what you call a pattern, or I don't care particularly about quote unquote patterns. What I care is institutional behavior. And institutional behavior will absolutely span decades. So what'll happen is we say, okay, there was selling pressure right here. The selling pressure lasted to a low in 2016, at the beginning of 2016, we came to the same level, we experienced the same selling pressure, and it came down to over here on this low. Then we came to the same level and we pushed it even lower. And then we came to the same level and it was more shallow. And then we broke out. What's important to me is that this wasn't a perfect one, but we came to similar levels right here, either similar levels or what I want to see is increasing levels. Basically what that means, that's institutional accumulation. It goes down and at every same level at the bottom, they accumulate. Or more, the better one is if it's sloped upwards, because if it's sloped upwards, that means they bought here, they went back, and then they came down and they bought some more. So basically their test told them that hey, yeah, this market is responding well, and so when it pulls back, they buy more. This market is responding well, and then pulls back, they buy more. This is the signs of an institutional buying campaign, or many institutional buying campaigns across many years. Remember, if we're talking about retirement and pension funds, which have the most amount of institutional money, they are absolutely taking decade-long, multi-decade-long viewpoints. They will hold their positions for many, 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 many years. So if they're accumulating right here, okay, that is the sign of a institutional, very large institution accumulation. And then we start to see, obviously on a smaller scale, the same thing. It goes up, it pulls back. It goes up, it doesn't pull back as far, goes up, doesn't pull back as far, goes up, not quite as high, and then it doesn't pull back as far. Each time it pulls back, it's at a higher and higher level. That is institutional accumulation until it breaks out. Whoever was accumulating this, they're done. That's why it was allowed to break out. If they weren't done, then they would shove it lower. They would shove it lower so that they could get more, and then they would until they're done. And then it's allowed to break out. Right, so maybe sort of missed the boat right here on gold, but I would wait for a pullback, and then, because this is, the expectation is that this can run for quite some time. Just like when we broke out of this one, how long did it run for? It ran from 2024 all the way till right here, so over a year it ran for. So this could run for quite some time, at least 6 months to a year, probably. And then what's really interesting is silver. Yeah, you guys are getting some premium stuff. I was actually thinking about doing a member only kind of big event on this. But silver saw something similar, or it is right here, it is starting to show signs of it. Okay, so we had one right here. Okay, that broke out right there. And then we have a baby one right here. Okay, so it ran up. Okay, we have a very baby one right here. Okay, and then we've got another baby one right here where we just broke out. Okay, but what's really interesting, if I go on to the weekly level, it's kind of happening on this longer scale right here. You see that? So if it keeps going and breaks, okay, so if this one breaks, then we could have another, it could run at least to this. It's debatable. Remember, we're looking at so many years that we're not going to be super precise in these lines, okay? So I would call it, oops, that's not what I wanted to do. I'll draw a box instead. Come on. So it'd be this box right here. So silver's looks a lot like it's going to run into this box. And if it consolidates or comes back down to this blue line right here, then that would be another very long-term pattern. Some people call that a cup and handle. Okay, and if it breaks out of that, then this thing could really go. This could end up at, over the next 10 years, or not 10 years, 5 years or so, it could end up at 200 to 300. So we'll see. We'll see. A lot of this silver, if you recall, historically, it was cornered. It was manipulated heavily. It still is, but it was heavily manipulated. It got cornered by these two brothers. I forget their names right now. And then finally there's regulation that broke it. And then that was back in the 70s or 60s. And then after that, it just took forever for silver to recover all the way until basically now. And if we can break through those levels, then silver really has room to run. Okay, so I'm going to be keeping my eye on silver for good entry points into silver and good entry points into gold. My whole point in sharing that with you guys was that there's increasing recessionary pressures. So why is all this money going into gold and silver, right? Are we another really good thing to look at is gold to copper ratio. So copper, what's the futures? XCUSD. It can't be coppers. It's not copper. Copper futures, really? That's what it's called? It's not called copper. What is, it's like a HG, okay, there you go. If we do the copper HG, copper futures divided by, I need to get this, HG1 divided by AU, 1, exclamation. There we go. So if we look at the copper to gold ratio, okay, so basically copper is very industrial, and if there's a lot of demand for it, that's a really good sign for the economy. And then gold is a safe haven, right? So if the copper to gold ratio goes down, that means money is moving strongly into gold, and people are worried about recession. And if money is really moving into copper, then the opposite should be true. However, very recently, we had this crazy thing happen to copper, which was Donald Trump's threat of tariffs. So we need to take the recent data with a grain of salt. So basically the 2025 data has to be a grain of salt. But what we see is that copper has been steadily increasing on gold for quite a long time. So it's not going to be a static ratio. It's got to be we got to look at that trend. And so we would be, oops. So when I draw a trend on ratios, I have to be judicious. I have to think about what I'm trying to measure. So if it's an uptrend, do I do cross the lows like I normally do? Or in this case, I'm trying to find an average ratio of copper to gold. And so I'm not going to collect lows. I'm just going to do the best fit line through the prices, okay? And so right now, what it looks like that HG very recently, back in July, now I have to look at the futures, or not the futures, the tariff news. But if this was a drop off because Trump, took his, rescinded his tariffs on copper, then this is not a valid data point for me. But if it's not related to that, this big drop right here, then what it implies is that money moved heavily into gold versus copper. And that would indicate a fear. So I have some homework to do. I've got to research what happened to copper with the tariff news and the pullback that happened afterwards. And if it coincides with this, then all the analysis I did, I just throw it out the window. But if it doesn't coincide with this, then I've got an interesting data point here that says, oh, maybe institutional money is starting to get a little skittish. So we'll have to do some homework, extra homework on that. Let's see what you guys are saying. If you put your buy in above resistance and it goes down, you will not fill, but if it breaks resistance, you will fill for the ride up. Hunt Brothers, yeah, thank you, Dan, on that gold. If I put gold, so I'm not quite following what you're saying, John. You're saying that if I put in my buy above resistance, so if you're doing like a buy stop, yeah, so it sounds like you're saying a buy stop, John, on gold. Yeah, you could do that, but at some point it's going to pull back, and you'll have better entry. That's basically what I was going for over there. Okay, silver better conductor than gold. Is it really? I don't know about that. All right, John, have a good night. Gold to silver ratio 88. Gold to silver ratio is traditionally 16. Yeah. Gold to silver ratio is quite high. So the silver is the better opportunity at the moment. That's right. Yeah. Past the highs. Right. So John, you're saying like maybe put it in a buy stop at like 340, maybe? Is that what you're saying? I don't know. I don't have the complete picture of what you're saying. I apologize. Okay. So let's see here. The other thing that I was saying that where we could find opportunity. So gold, silver, those are decent opportunities in the market right now. SPY appears like it's probably going to chop at least for a little bit. You can focus on 0 DTE. Chopping movements sideways, or you could do neutral trades, neutral spreads, like an iron condor or a butterfly, in order to try to capture some of this. So for example, I wish a lot of things on this computer stopped working when I left for a week for some reason. I can't get Thinkorswim open. It just says installing updates forever. So I've had to use multiple computers today in order to trade. But today, this morning, what I gave on the public Telegram channel were these gamma levels. And I said, hey, 650 on SPY, but don't really necessarily count on it pinning there because SPX doesn't really agree. It has a much wider spread. And we closed at 648.83, so okay, not great, not perfectly on 650. When I see a gamma level like this spike, I go plus or minus $1 is what I count on. I'd say, hey, that's that it predicted it pretty well if it's plus or minus $1. This is $1.17. So I guess it did okay, but not perfect. But so the combination of, hey, don't count on it pinning there, but it looks like 650 might be a focus in the market. So if we saw how it actually behaved, SPY actually behaved, let me draw 650 for you. Okay, and then let me show you what time we set it. Okay, so we set it at 7:07, 7 minutes, so 37 minutes after the market opened. So 7:07 my time, California time, we set it right there. Okay, and we came pretty close. We came pretty close to that 650, and then it rejected it. So one good way of trading that could have been a debit put vertical right here as we were getting close to 650. You could have right around 649.75, 649.80. You could have initiated a put credit spread. That would have given you potential for probably 70 to 80% on the day. Would have worked out really well. The other thing that you could have done is that when we hit these lows right here, pre-market lows, match that pre-market low, okay, or we match that pre-market low right here, you could have then potentially decided to go long, call vertical. You would have been scared for a little bit, but ultimately it would have worked out for you. So that would have been really a bit nerve-wracking. What I ended up doing, I can't show you because I did it on one of my Thinkorswim accounts, but let's see what we did over here. I wish I could somehow show you these screens over here, but I did a so basically a 5 wide butterfly around 650. Okay, so where'd that 650? Okay, so 5 wide. That would be from 650, 645. Okay, so I did a butterfly centered around 650, and what that did was it gave me a lot of leeway. Actually, the market could have gone as high as about 652 and about as low as 647, and then did I do that? 653 and 647, and I would still make at least a little bit of money. Okay, and so we closed up here at 648.87. And I ended up making about 40%. So max potential was a little over 100%, just barely. Okay, so 1-to-1 reward risk ratio was very good. Since we didn't pin at 650, we got 648.87. I made about 40%. And then if it would gone down to 647-ish, I would have broken even. Okay, so there's a lot of ways that we can take advantage of that, but this is one of the things that you can do is you can focus more in on zero DTE and neutral strategies. So because we're probably going to keep on shopping or maybe float a little bit higher. But again, so you saw the thing I love about those butterflies is that they give you so much leeway, right? So there's very strong gamma at 650, as I showed you guys over here in the Telegram. So the likelihood of it moving significantly beyond 650 without a strong catalyst was very, very, very low. So if I'm safe all the way to 652 or 653, man, that's a great high, very high probability trade. And I can still get a 1-to-1 reward risk ratio. If I wanted to narrow it, so for example, on, was it Friday? No, the day before that. No? Here. Gosh, which day was that? One of the days where I said it, I thought it was Friday. I said it was likely to pin. Do you guys remember that? Oh yeah, here. So most of the time suggests market will pin at that level. So 645 on Monday or Friday, and obviously it did not do that. Okay, the low on the day was 643, and we ended up closing at 647. Okay, so we closed quite a bit above that, 647.24. So we are 2.24 away. But even with that, if we did a butterfly at 645 with a 5 wide spread, which is what I ended up doing, I only lost like 3% or 3 to 5%. So these are really, really favorable, high probability trades. And what's great about them is the risk reward, or the amount of leeway that you get for being wrong. And so it's very hard for you to go to the point where you end up losing more than you could have won. So I like the butterflies for these types of setups. I think one of these days I'll probably put on maybe like a 1 week of zero DTE trading for everyone. I don't know if it'll be open to everyone or to members. Let me know if that'd be something interesting to you guys. If I said, hey, a half hour after the market opens every day for a week or two, we'll take a look at gamma levels together. We'll take a look at what's indicating on the software, and then we can put on some zero DTE trades. If that's interesting to you, just let me know. Send me an email. Say, hey, I'd love to see that, and I can put that together. If no one's interested in it, then I won't bother because that would be a lot of work for me. Okay. Quick Bitcoin charting. Bitcoin's chopping. It's got strong support right here at around 107,000, 107,310. Okay, basically the lows of this. So basically it's chopping. It's still, if it goes up, it has that MA50 to contend with. Then it's got these highs up here to contend with. So I wouldn't be interested in adding to Bitcoin until above the MA50. I'm not interested in shorting Bitcoin at all. So most likely just chop for a while. If you wanted to, if you could find some Bitcoin ETF like IBIT, for example, it's very similar. You could throw an iron condor around that. And then if it breaks above and you end up losing on that iron condor, you set yourself kind of sort of like what John Short was saying. You could put a buy stop above that MA50 and catch a move to the upside. That way, if you lose on the iron condor, you still have potential to make good on a strong breakout. Let's see. PPI out on 8:30 on Wednesday. If the numbers are not good, SPY is predicted to drop hard fast. If the numbers are not good, that means poor, that means higher prices, then it depends on how it changes this, okay? Because right now, basically, the market is saying we're going to get rate cuts. If the only thing that could happen is that PPI comes in super hot and the Fed goes, oh my God, if we start raising rates now, then inflation has to become a bigger problem than jobless claims. And right now, I don't really see that. It would have to be some really terrible numbers on PPI to get the Fed to say, okay, let's focus back on inflation. Right? So, if that does happen, then you're correct. If basically what you're saying is, if the probabilities of us getting a rate cut on September drops significantly, then yes, there would be a major pullback or sell-off in the S&P 500 at that point. Yeah. Okay, getting people interested. I was thinking you're going to send an alert for the Gamma program. I love it when you post levels. I might teach how to use the Gamma software for zero DTE trading. That I will do for sure. But I can teach outside of that also. I can teach to a wider audience. It's just that some people won't have access to Gamma software. Can I give a midday Gamma picture on SPY? Usually if I don't give a midday picture on SPY or SPX, then it hasn't changed. Normally if it changes, I do give an update. Yeah. Okay. Oh, Venkat relies a lot on my Gamma levels for zero TTH. Oh, good to know, Venkat. Have you been seeing good success with it? No. SPY has been going up insanely, due for some correction 3 to 10%. Yeah, that's true, but it's never ever clear ahead of time exactly when that's going to happen. Yeah, but we can be pretty confident that it will happen. Or what will happen is this will consolidate for a while, That'll give time for these moving averages to catch up. And then at that point, you'll go up or go down. I think I went over that last week while I was in Europe, where we cross these moving averages, and then it'll pick a direction, either down, which would become fairly bullish if it doesn't get caught by that MA200, or it can move higher from there. Okay. All right, guys. I think that's going to do for now. Just SPY, mostly chop, is going to be hard to move it up significantly at this point. It can float higher. But it's going to be hard to get like this type of really strong directional movement. For now, it looks fairly choppy, maybe a slight bullish bias, but again, a pullback to the MA50 would only be, I think, not even 2% at this point. 2.2%. So it'd be nothing. More. So a movement down to the MA50 can easily be accomplished and it wouldn't be a big deal. Although for some people it might feel like a big deal, but it wouldn't be a big deal. It'd be perfectly normal. Okay. Venkat says, yes, I do. I sell 10 points above the number you give. The best. Oh, okay, great. Yeah, that's great. If you can make consistent profits, excellent. It doesn't matter if they're smaller or bigger. Consistency is much more important than size. Okay, consistency will build in size over time. Okay, guys, that's going to be it for today. Have a great rest of your day, and I will see you guys tomorrow. Ion condors can be, as long as your reward risk ratios make sense. Yes. Yeah. Okay. All right, guys. I'll see you tomorrow. Have a great rest of your day. Bye, everyone.